continue to look at these prices because, as we've been saying, prices for all kinds of goods have risen sharply from this time last year. Some of the largest hikes have come, of course, at the grocery store. Meat, fish, poultry, eggs costing more than 10% than they did last September. Fruits and vegetables also up 3% from 2020, and alcoholic drinks up nearly by the same amount. I mean, even clothes that some people said would be impervious to all this, they too have jumped 3.4%. Mark Zandi is the chief economist at Woody's Analytics. And yep, we want the economist to weigh in here. Please help us, because from a structural point of view, let us know, is anything changing here in a fundamental way? And given inflation really hasn't been a substantive issue in decades, do central bankers have the tools to tame it if they need to?
Yeah, I don't think this is a long-term problem. I think this is a direct function of the pandemic. I mean, the pandemic has just significantly disrupted global supply chains and job market. I mean, a simple example, the Delta variant came along, it made everyone sick in Malaysia. They had to shut down their chip plants because they didn't produce chips. The global vehicle industry couldn't produce, including here, the Ford F-150, the most popular vehicle in the United States, couldn't get produced. You have shortages, so prices rise. So, if that's the right diagnosis, if it's about the pandemic, then as the pandemic winds down and the Delta variant is winding down, then these supply chains should start to iron themselves out. Sick people can go back to work. People that are fearful of getting sick can go back to work. Parents can go back to work, take those jobs, and this all starts to work its way through. Now, no, Paula, I don't think that's next month. That may not be next quarter, and I don't, it may not be a straight line because this pandemic has a life of its own. But I do think by this time next year, certainly by early 23, we'll have worked through these issues and inflation will be a non-issue.
Which is still a long way away, and in the meantime, all production costs, including labor costs, continue to go up. A recent Moody's analysis said that this spike in production costs heightens the risk of what you guys call sticky inflation dynamic. I want to ask you, given that, when you look at the Fed's position right now at the hour, in terms of tapering, interest rates, anything surprise you?
No, I think they bought into and they believe the forecast I just gave you, that inflation. Well, obviously it's painful. I mean, just to give you a statistic, the typical American family is spending $175 more a month because of the higher rates of inflation. So this is not, fun. It's a painful thing. But all the dynamics suggest that, 12, 18 months down the road, it will begin to fade. And by the way, global investors think the same thing. This is why stock prices are, they're still pretty close to record highs. Bond yields are very low, and the inflation expectations embedded in those yields are, right where the Fed wants to see them. So people who put their money where their mouth is, they're saying, look, yeah, inflation's a problem. We don't like it, but we don't like the pandemic either, and we're going to have to get through it. And if we do, and when we do, inflation will settle in. So I think the Fed, has what it's got its grip on this. And by the way, if we're all wrong, and it's possible that we're wrong, and inflation remains more persistent, then yes, the Fed does have tools. I mean, it's pretty straightforward, right? I mean, interest rates are at zero, so you would raise interest rates to try to cool things off and get that inflation rate down. But I think that's a scenario. It has a probability, but a pretty low probability.
I'll push back a little bit, only because before this we had been talking a lot about income inequality, right? And when you look at those basic goods going up 5 or 6% and people having to maybe take a 3-4% hike on wages, perhaps it doesn't really all come out on the wash. I guess what you're going to tell me is, Paula, calm down. This is strong demand, which means that there is a strong global economy backing this.
Yeah, I mean, think about the counterfactual, what the world would have looked like if we didn't get that help. If low-income households didn't get stimulus checks or unemployment insurance or rental assistance or food assistance, all the things that went to help support the households that are under severe financial stress, the low and middle income households. And think about, what the world would look like. I mean, inflation is not great. I don't like it. But I take that over high unemployment, underemployment, and people who can't pay their bills or getting evicted from their homes. So, yeah, I mean, it's not great, but, it's much better than the alternative. And I will say, if you look at the net of all of this, all of the cash that went to lower income households and the fact that, unemployment, we've created a lot of jobs, unemployment has come in, and wage growth among low income households is extraordinarily strong. That's where the labor market's been tightest and where we've seen the biggest pay increases. The higher inflation certainly dings the finances of low and middle income households, but I think if you take the net of all of it, they're probably still coming out better, meaningfully better than otherwise would have been the case.
Yeah, and it's important to have that insight into the data, right? Like you said, if you look at those low-income households, they still have some pretty significant purchasing power vis-a-vis what they had in 2019. Mark, always good to see you. Really appreciate it.
Thanks, Paula.